ETFs, index funds, mutual funds, hedge funds. You've probably heard these terms 100 times. They control trillions of dollars around the world. But for most people, they're still confusing. What do they actually mean? Why does Warren Buffett swear by one of them, while investors like George Soros used another to make $1 billion in a single day? Today, we're cutting through the noise. I'm breaking down the big four in clear, simple language, how each one works, what makes them different, and which one is actually the smartest choice for you as an investor. Let's simplify this once and for all. What is an investment fund? At its core, an investment fund is simple. It's people pooling money together to invest as one big group. Think of it like everyone chipping in for a giant pizza. Except instead of pepperoni slices, you're getting slices of stocks, bonds, or other assets. We do this for three reasons. Diversification. A single investor might own 5-10 stocks, but a fund can own hundreds, spreading risk instantly. Professional management. No staying up at 3 a.m. Googling, "Is Tesla going up tomorrow?" A fund manager, your algorithm, does the work. Access. Some funds let you buy things you'd never access alone. Foreign markets, commercial real estate, or entire economies. Fun fact: the first modern mutual fund launched in 1924, the Massachusetts Investors Trust. It allowed everyday people, not just the wealthy, to finally own a piece of the stock market. Nearly a century later, that same idea still powers global investing. Mutual funds, the classic choice. A mutual fund is a basket of investments managed by professionals. When you buy into one, you don't directly own Apple or Microsoft. You own a piece of the fund that owns them. Think of it like hiring a personal grocery shopper. You give them the money, they return with a cart full of items. Ideally more than just chips and soda. Mutual funds come in two main flavors. Active. Managers try to beat the market. Passive. The goal is simply to match the market. Active managers are like chefs trying to invent a new recipe. Passive funds just follow grandma's proven cookbook. Both feed you, but one takes more flair, effort, and ego. Legendary example: Peter Lynch and the Fidelity Magellan Fund. From 1977 to 1990, it averaged an insane 29% per year. $10,000 grew to over $280,000. But here's the catch: most active funds don't have a Peter Lynch. After fees, the majority underperform the market, and those fees, often 1 to 2%, may sound small, but over time they're like someone taking a bite of your sandwich every single day. Eventually, you're left with crumbs. Still, mutual funds dominate retirement accounts like 401, Ks in the US, and RRSPs in Canada. For many people, it's their first introduction to investing. Index funds, the game changer. If mutual funds are the family car, index funds are the sleek, fuel-efficient hybrid that changed everything. An index fund simply tracks a market index, like the S&P 500. When the index goes up, your fund goes up. When it goes down, you follow along. This simple idea was championed by John Bogle, founder of Vanguard. In 1976, he launched the first index mutual fund, and Wall Street mocked him. They called it Bogle's folly. But decades later, he had the last laugh. Index funds have ultra-low fees, sometimes as low as 0.03%. That's the difference between paying $3 a year or hundreds. Over 30 years, that gap is massive. Warren Buffett even said that when he passes away, 90% of his wife's inheritance should go into a simple S&P 500 index fund. Not hedge funds, not exotic trades, just the plain, boring, brutally effective index. Because being average in the market is actually extraordinary. Um, if this breakdown is helping you finally understand investing terms more clearly, tap that like button. It tells YouTube this content actually helps real people. And if you're new here, welcome to Dave Finance and Investing, where we make investing simple for everyday people in the US and Canada. ETFs, the modern favorite. If index funds are the dependable workhorses, ETFs, exchange-traded funds, are their flexible modern cousins. Just like index funds, ETFs hold baskets of investments. But here's the key difference. ETFs trade exactly like stocks. You can buy or sell them anytime during the trading day, not just after market close like mutual funds and index funds. The very first ETF launched in 1993, the Spider S&P 500 ETF, also known as SPY. Today, it's one of the most traded investments on the planet. But here's what makes ETFs so powerful. When you buy an ETF like the S&P 500, you instantly own a slice of the 500 biggest companies in America. Companies like Apple, Microsoft, Amazon, Google, and Tesla, Nvidia, and 494 more. These are the giants driving the US economy, or so. And instead of buying them one by one ETF lets you own all of them with just one click. And it doesn't stop at 500 companies. Some ETFs hold 1,000 companies, total market ETFs like VTI, over 3,000 companies, global ETFs, even 10,000 plus bonds and assets in some diversified funds. With one ETF, you can own more companies in a single purchase than most people pick in a lifetime. What is Warren Buffett's opinion? He famously said this: I recommend investing in index funds. And specifically, as I said before, he wants 90% of his wife's inheritance to go into a simple S&P 500 fund, not into hedge funds, not into complex strategies, into low-cost, broad ETFs. Why? Because ETFs remove the guesswork. You don't need to predict the next Apple or Amazon. You own them all from day one. ETFs also give you incredible flexibility. Want to invest in clean energy, cybersecurity, dividends, emerging markets, space exploration? There's literally an ETF for almost anything. It's like walking into an ice cream shop with 1,000 flavors. But here's the warning. More options means more temptation. The ARK Innovation ETF is the perfect example. Huge gains in 2020, followed by huge losses right after. ETFs are phenomenal tools, but they work best for broad, long-term investing, not short-term chasing or gambling. If you stick to simple, diversified ETFs like the S&P 500, you're following the same long-term strategy used by Buffett himself. Hedge funds, the private clubs. Now, if ETFs and index funds are for everyone, hedge funds are the VIP lounges of investing. They're private partnerships, usually for the wealthy or institutions. And they can do almost anything. Short stocks, Use leverage. Bet on currencies. Trade complex derivatives. They're the Formula One cars of finance, are incredibly fast, incredibly risky, and definitely not for casual drivers. One of the most famous hedge fund moments? In 1992, George Soros's Quantum Fund made a $10 billion bet against the British pound, earning $1 billion in a single day. That's the day he became known as the man who broke the Bank of England. But hedge funds come at a price. The classic 2 and 20 model. 2% annual fees, 20% of profits. Even if you win, your manager wins bigger. High risk, high reward. And out of reach for most everyday investors. The big picture side by side. Here's the quick comparison. Type, accessibility, fees, liquidity, risk level. Index fund, open to all, very low, -0.03%. End of day, low, ETF, open to all, low, anytime, low medium, mutual fund. Open to all, medium high, 1-2%. End of day, medium, hedge fund, accredited investors only. Very high, 2 plus 20%. Locked up, high. Which one's right for you? For most people, index funds or broad market ETFs are the smartest choice. They're simple, they're diversified, they're low cost, and they've consistently beaten most active managers over time. If you want hands-on control, ETFs give you flexibility. If you prefer a hands-off approach, index funds are set and forget perfection. If you're ultra wealthy and love risk, sure, the hedge fund world is there. But even Warren Buffett proved in a 10-year bet that a simple S&P 500 index fund crushed hedge funds by miles. At the end of the day, simplicity wins. You don't have to outsmart the market. You just have to stay in it. So now you understand what ETFs, index funds, mutual funds, and hedge funds really are. And you know which one is truly best for your investing future. If this video helped you see things more clearly, I'm genuinely glad. Because once you understand these basics, everything else becomes so much easier. And if you've decided you're ready to start investing, check the description below and watch my video. Stock Market Investing Made Simple. In that video, you'll learn that you don't need thousands of dollars to begin. You can start investing with as little as $100 by buying simple ETFs like the S&P 500 and let time, patience, and consistency do the heavy lifting. Thanks for watching, and as always, invest safe, invest simple, and let time make you wealthy.